I want to check in on some of these numbers and market reaction to the data that's hitting the wire right now. We have Scott Bauer, he's the CEO of Prosper Trading Academy, joining us this morning. And, well, Scott, welcome. Thanks for giving us part of yours. The focus this week, thanks to you, the focus this week, well, in addition to the Fed, I guess I should say, is pretty squarely on the housing. We had housing market index yesterday from the NAHB. We had the building permits today, the housing starts. We'll pull those numbers in just a second, but new home sales, existing home sales, we were talking copper, but this feeds into that sentiment and certainly feeds into the discussion in terms of some of the trends we've seen throughout the pandemic.
It absolutely does. And recently the trends have been a little bit weak. Mm-hmm. You know, maybe we saw that a little bit out of Lennar's report yesterday. We've got KB Homes coming up, but the numbers this morning, pretty solid.
They are
better than expected.
Yeah.
The starts, the permits. So, you know, what do we make of this? I don't think it's a game changer at all. I actually think this is a good thing. Maybe it stems the tide from some of the negative news that we've seen recently. But I do think the housing market is still very robust, very strong. And you know, with where rates are right now, it's an affordability issue. But it's an affordability issue because where is the supply and demand? And we all know, as JB was just talking about, you know, in your previous segment, it's hard to find a house out there. Mm-hmm. It really is, even though, you know, mortgage rates are extremely affordable.
Yeah, multiple friends of mine, friends in my running group and so on that have just been priced out or have just been frustrated out of the whole process in general. Yep. I mean, getting, you know, outbid multiple times, and they've just are spent literally. I wanted to talk about these numbers. Building permits up 6%. Housing starts, again, up, looks like almost 4%. These are pretty good numbers, as you mentioned, both topping expectations and prior. It looks like the housing starts got revised up. Scott, there's a lot of discussion, kind of a back and forth argument as we head into this Fed meeting in terms of old data versus new. There was a lot of talk about some of the forward-looking indicators. Oftentimes, this is tied into that discussion with the building permits being one of those. It's seen as sort of a precursor right now. But all of this, in theory, Scott, or these trends that we've seen with rates at historically low levels, I mean, one could argue that they should continue, whether we're talking indices and that being the best place for investors and traders to kind of park their money, or again, in terms of some of the real estate trends we've seen. I mean, again, rates haven't really changed, so there's no real shift in terms of that dynamic.
They have not. I mean, you know, we've still seen a scenario of range-bound area of rates. So, as you say, I don't see what really changes the landscape here other than, you know, if we really start to get a big dip in consumer confidence, if people start getting, you know, scared about spending. But I don't think that's in the cards anytime soon.
You know, Scott, speaking of in the cards here, real quick, give me 1 second because I got a couple charts I want to pull up and some cards to deal here, so to say. And, you know, to the point here, rates on the top of this chart, the ES on the bottom. You can see the trend environment to the upside rolling over some, but rates still in this range, pretty well defined. They've got the 30 on the top left corner, the 10-year on the top right, and then again, as mentioned, the ES, the trend up on the bottom. Now, just to zoom in, look on the 30-year, the longer-dated TYX here, range-bound, comfortable around 1.9, 1.85. Look at the TNX around 1.3, but one thing I'm noticing, and I wonder, Scott, if we start to see this massive crossover, the yield curve we've seen, you had seen the steepening, I should say, into the spring, but you can see how it's flattened out quite a bit here recently, and this could raise some concerns here. But let's talk a little bit about the Fed and expectations and what we should be watching because for one, again, whether you're talking rates, treasuries, or the U.S. dollar, for the most part, in a bit of a holding pattern heading into this meeting, do you expect any waves or them to create a bit of a wake?
You know what? I really don't, Ben. I don't know. I don't think I've seen any sort of economic data over the last weeks and even the last months that would make the Fed have a decision to change the course that they've already kind of pre-planned, quite frankly. We know the taper is coming. I don't see how they can taper sooner rather than later, meaning, you know, pull the plug here on an announcement tomorrow that it's going to happen anytime this quarter or fourth quarter. I just don't see that. I do think the rhetoric is going to be that, you know, the course is steady and we're going to start seeing it first, maybe even second quarter of next year. I really think that Powell and the Fed is kind of in this Goldilocks rosy scenario that the tapering is still further off than people may think.
Scott, does that create a scenario for the markets in terms of the indices and markets in general, I guess, where they're kind of happy with that Goldilocks scenario, as you mentioned, and say, hey, look, the Fed status quo is supportive of some of the trends that we've been talking about? Or do they say, well, we should have been in the taper mode already by this point, and the fact that we haven't been able to get to where they wanted us to be? I mean, in theory, many expected us to already be in that mode. I mean, would that start to raise some concerns in terms of what's to come and some expectations for the future?
Absolutely. And I think they believe that. I don't think they're going to come out and say that, but I think they believe that. And, when you hear Powell talk about how inflation is transitory and that they just haven't gotten to the point yet on the employment side of where they want to be, I think you can read through the lines there and say exactly what you just said, that, you know what, we should be there and we're not. So does that raise some concerns? It should. It really should, because we should be absolutely booming on all cylinders, and we're not.
Scott, you bring up a couple of good points there. Obviously, the jobs, the disconnect right now between, again, the labor force and these positions that are available speaks to some of these existing trends that have been created by the pandemic, and it's been difficult to explain in many ways. Jobless almost back to levels that we saw pre-pandemic, but still 10 million plus positions available. Let's talk a little bit about, again, treasuries and some of the reaction we saw, the price activity you were watching yesterday, Scott, as the indices sold off. I just wanted to get your thoughts, because earlier in the show, I mentioned with colleague Garner about some of the gold kind of risk-off type price activity we saw with the bid come into play. But I noticed, and I just want to point out as we get your thoughts on this, if I could just pull this chart for our viewers, what I really kind of, what stood out to me is how we had the bonds inching their way back up towards those highs from last week, but unable to take out those highs from last week. And I mean, again, follow through somewhat limited, I guess, to the upside, signaling investors, traders were not as concerned as it seemed we could have been or should have been maybe, or maybe, might have been amidst some of the news. Treasury seemed to have a very level-head approach to some of the selling, as we've seen the indices now kind of take that same position as they've come off lows.
No doubt about it. And as a trader, for doing this for a long time, Ben, and you as well, you look for those points of capitulation where you can see, a massive turn. We absolutely did not get that yesterday. Even when the market was at its lows, the Dow down about 1,000 and S&P's down over 100 points there. There was never really, at least from my perspective, that point, that sense of, oh man, that's it. Never got there. And if you look at some of the metrics, and especially the VIX or the vol of the VIX, it really held to the trends that we have still seen over the last 12 to 18 months, where it did pop, but it still made lower highs. And it did not break through those recent highs that we had seen. So I'm not saying that we need to get to that point of capitulation, but it certainly wasn't there. And if there's ever a scenario, if there was ever a situation of an orderly, 2% or 3% sell-off, yesterday was certainly that.
Speaking of orderly, speaking of the VIX, a series of lower highs that we've seen on the daily time frame. Scott, if we could just pull this chart, this is how we started the show off for the most part. Looking at the indices coming off the lows, Scott, you mentioned again a nice move up yesterday, but also again, as you've mentioned here, we've seen a series of lower highs recently as we've come off. The VIX has made a very tame and kind of, again, also level-headed approach towards. So something to watch here. Scott, we're going to continue this discussion. I'm going to take a look at the dollar, and very similarly up, but limited in terms of movement yesterday in terms of that safe haven flight to quality type move. Scott Bauer, the CEO of Prosper Trading Academy, joining us to talk financial. Thanks to you, Scott.